Hello, I'm Clifford Bennett, Chief Economist, ACY Securities, and thank you to another lockdown edition. But there is certainly a lot of energy in the world at the moment and a lot going on. In the US, we saw the Fed minutes, which confirmed the view we've had for a very long time now, that tapering was imminent, would happen at any moment in any month very, very soon, and certainly this year. It was surprising to us that some people were still forecasting tapering wouldn't happen until next year. So the Fed has now said that tapering is on the agenda. The next meeting, they're going to make some sort of announcement along those lines, whether it's an immediate reduction of some degree, or whether they say at the following month they'll give a timetable. So, or start cutting straight away. So tapering is definitely happening. Now, that cannot be viewed as a positive for the market, and people will spin it as, well, it means the economy is strong. Well, we know the economy of the US is already back near previous levels. It still has some supply chain disruption issues. It still has another COVID surge going on, excuse me, but it does look like interest rate hikes, which are the further step beyond tapering, are going to come forward as well. And that means we're going to have an interest rate cycle in the United States starting next year. Now, that's been our central forecast for quite some time. We've been way out of market with that forecast, but suddenly we're starting to see other people move in our direction. And in fact, we knew the Fed would be tapering this year before the Fed knew it. And I wrote that at the time. So that's a slight negative for stocks, but I don't really think the stock market in the US fell because of the Fed minutes. I think it was a coincidence that it happened on a day that US stocks were going to be falling anyway, because there are signs of buyer exhaustion, that inflow of capital from the rest of the world starting to sort of peter out, and a lot of domestic fund managers in the US are still very cautious on these valuation levels. So as that offshore buying starts to peter out, there's only downside potential for the US stock market at this point, given its strong levels of valuation, too high levels of valuation, and given that the US economy is definitely going into a slowing down phase. And one of the points I've been enjoyed making, well, enjoyed is a strange word, but always wanted to point out, is that the US has already experienced its second housing bubble of this century. So we had that in 2007, 2008. We know what happened to the stock market then. This is a smaller version of that, but it is a property bubble nonetheless, and that is rolling over or bursting, hopefully not bursting with too much of a pop, but certainly deflating, rolling over in a whole host of indicators in the US, from mortgage applications to new home starts and those sorts of things, as prices go up. So that's what a bubble is. And I think we're going to see housing prices in the US begin to flatten out, if not roll over themselves, to follow the direction of the US economy of late. In Australia, Sydney Airport, Canberra Airport, now sort of red spots in terms of the COVID crisis we have here. Nice to see Queensland getting things under control. Nice to see perhaps the ACT getting things under control. And I think the authorities in both New South Wales and Victoria are doing their very best. But these states, these cities have much higher population density, cooler climates, and that really is a difficult hurdle for anyone trying to keep cases near zero to overcome. There's a whole lot of other aspects to that, of course, but what it does mean, whether we agree with it or not, is lockdowns are still in place for Melbourne and all of New South Wales. New South Wales lockdown is likely to be extended statewide beyond the 28th of August. The Premier is trying to come up with some way of softening that lockdown, but it could be very difficult for her to do so should the case numbers continue to rise the way they are, or even plateau where they are. And in fact, they're so high now that even if they came off a little bit, it would still be very difficult to lift any of the lockdown measures currently in place. It's the hospitalizations that will stress the system. An extremely high hospitalization rates, probably around 10% of known cases. that is very high, and it is putting pressure on the hospitals in Sydney having to deal with this. Doesn't mean they're not coping, they're coping perfectly well. They're just starting to feel a little bit of pressure, and that will make it hard for the Premier to reduce the lockdown aspects that we currently live in Sydney. If you're living elsewhere in the world, you also have a terrible Delta surge crisis. However, your governments may not be locking you down because you've already had that wave of tragedy that Australia and New Zealand have not had. And so these nations are trying to hold that at bay. Again, doesn't matter what your view is on that. The fact is, this is the approach those governments will be taking. In terms of the economic impact, you can only read it that way, which means I've been saying all along, we forecasted a week ago now that Australia was already in recession. So Q3, Q4 will see negative economic growth. I think that could even lead into Q1 if the Delta surge continues. It's feeling like a little bit of a freight train headed our way at the moment. So this cannot support Australian stock prices where they were, and that's why we're seeing the Australian market fall. We've predicted this. We've been really screaming from the rooftops for people to manage and come up with defensive strategies using all the tools that are available in financial markets these days. And remember, it is the individual investor who has the advantage, being able to make decisions, looking out the window, figuring out in a common sense way what's going on in the world, and being able to react far more quickly than the big funds and investment banks and banks can, because these days all those people are trying to make all the decisions by committee. As John Maynard Keynes said, trading by committee is a sure path to failure. Australia's unemployment number was looking really good today. That was the only bright thing about the economic outlook perhaps, but again, it's like earnings. It's backward looking. It's for July. In July, at the end of July, most businesses thought any lockdowns were going to be just 2 or 3 weeks and we'll be straight out of this and we'll have that fast economic recovery. The Reserve Bank told everyone the economic bounce back will be fast. The government said the economic bounce back will be fast. And that's just not going to be the case. So those scenarios are starting to unravel in terms of market sentiment. And again, even though we had a good unemployment number for July, that's not going to be the case for August and September and October. So that's immediately being discounted, and I think the market is very vulnerable here. So individual investors and traders, you have the advantage. We have the advantage. And I think that advantage is very much about pretty equal flow of information, but the ability to change our portfolios and hedge our portfolios more rapidly than anyone else. And hedging and defensive plays have been what I've been talking about for a very long time now. I think the Australian dollar will continue to fall. I'll say it again, we forecast at 77.45, the Aussie would go to 70 cents. People thought that was a bit silly at the time. We're almost there. It's a little bit of support around 72.20 to 72.50. That's those low 72 areas. But I think we're going to go to 70 cents. And I've always said from the very beginning, the risk was 68.50. I think the currency has pointed the way for the stock market. The stock market is just beginning to follow the currency's lead. So people in the equity market have really been buoyed by some of these things, such as the purchase of Afterpay, the great numbers out of CBA, etc. But earnings is looking backward, as I recently said in a television interview. And a lot of people doing bullish forecasts on the Australian market were saying earnings are strong, therefore the stock market will go up. No, the stock market's already up because people knew earnings would be strong. And now the future outlook for earnings, given that Australia is going into recession driven by lockdowns and without the same stimulus measures as last time, there isn't a broad sweep of JobKeeper. There's more targeted support for people, and that is appropriate. I support that. But it means that you're not going to have this massive excess of funds in the society that we had last time. So, and again, should I use the analogy again? You can't see it, but I've got 12 sofas in my lounge room. No, I haven't, but it's my way of pointing out people are not going to be buying the way they were in the first sort of experience of COVID last year for Australia. Remember, our economy overheated because you had the Reserve Bank with near record low interest rates. You had bond buying program by the Reserve Bank, and you had massive stimulus. And on a per capita basis, Australia was pretty close, if not leading the world in terms of stimulus for COVID, and yet we had the lowest case numbers, which is why we came screaming back with our economic growth once the lockdowns were removed. This time around, Delta variant, as we all know, it's a tougher creature to get on top of, and it means that we're not going to come out of the lockdowns as quickly, but when we come out of the lockdowns, there's not going to be that fast bounce back in the economy, and that's why I see this recession possibly stretching into Q1. Outlook for Australian stocks, the Australian dollar remains extremely negative. It remains, the dominant risk, you have to say, is very much to the downside for even further sharp falls. The Australian stock market can have a momentary being dragged up should the US market start to rally. But the big danger perhaps for the Australian market is that the US market's going to remain heavy. In fact, US stocks have a bit of a fall themselves, and then it's really hard to find any leg to stand on in terms of being bullish the Australian market. And this is at a time when there's broad-based leveraged long positions in the Australian market, including from major fund managers. If all of that begins to get unwound, the Australian market can go significantly lower. So our job is to help you manage risk. And the risks at the moment are probably more significant than the market is pricing, and therefore the market has potential significant downside. Have a great day. Wishing you all the best. Stay on top of everything, but do be very active about hedging your investment portfolio, or at the very least, consider what your strategy might be if this downside development of the last few days to a week, which isn't a big stretch of time in the big picture, but should that start to continue to encourage the view that there's further downside here, you need to know in advance how you're going to deal with that, what hedging strategies, what investment tools are available to you to hedge that portfolio. Thank you very much. Clifford Bennett, Chief Economist, ACY Securities.